Are you an established small business owner or aspiring entrepreneur? Would you like professional advice to help your business grow and succeed? Well, look no further. The Virgin Islands Small Business Development Center is the territory's #1 resource to move your business forward. Enjoy no-cost advising, low-cost training, and technical assistance from experts in both the public and private sectors. The VISBDC is nationally accredited and sustained by the University of the Virgin Islands and the U.S. Small Business Administration. Visit us at our locations on St. Thomas, St. John, or St. Croix, and follow us on social media at VISBDC. For easy access to all our training and networking events, be sure to join our newsletter and download the VISBDC app. The Virgin Islands Small Business Development Center, here to help your business start, grow, and succeed.
Hi, good morning, everyone. Thank you for joining us today. In honor of Financial Literacy Month, we are dedicated to providing our small business community with the tools and knowledge necessary to build a strong financial foundation. Finding capital is often one of the biggest hurdles for entrepreneurs, whether you're just launching or looking to scale. Today, we're going to demystify that process. My name is Sharika Industrious Phillips, and I am the Network Marketing Coordinator here at the VISBDC. We are fortunate to have a true expert with us. Joining us today is Rohit Kiani, Vice President and Chief Credit Officer at Merchants Commercial Bank. Ro brings years of high-level banking experience and a deep understanding of what lenders are actually looking for when they review your applications. Here's a friendly reminder to place your questions in the chat, and they will be addressed by the presenting team either directly in the chat or later during our question and answer segment. A copy of today's presentation will be attached to the post-survey email sent after this live session. We encourage you to take a few minutes of your time to briefly fill out the survey that lets us know how we are doing. This data is essential to us rendering these deliverables complimentary to you. Ro, once again, thank you for being here, and the floor is yours.
Thank you so much. Good morning, everyone. Thank you for taking time out of your day to attend this session. A little bit more about me in the background. I serve as the Chief Lending Officer and Vice President at Merchants Commercial Bank. Title recently changed, Sharika. I forgot to tell you that, from credit to lending. In this capacity, I oversee the lending function. That's consumer and commercial loans. Which includes SBA 7A loans and loans that are supported by the EDA's State Small Business Credit Initiative. That's a credit enhancement that we'll talk a little bit about today as well. This is intended to be a very high-level overview about what you can do to prepare yourself to approach a bank or another third party for financing, and how to get yourself bank ready so that you can capitalize on that opportunity when it arises. There's a lot of additional detail that we can provide you and give you additional information on. There are going to be some other resources, but should you want to talk to a banker, you can always reach out to us directly by sending an email to lending@merchantscommercial.bank. I'll provide that email address again later on in the presentation. Having said all that, let's go ahead and get started. My slideshow wants to cooperate. There we go. There we go. Okay. So that's, again, just a high-level summary of what we're going to be talking about today, and, of course, our handy-dandy logo. The agenda for today's session, we'll talk very, very high-level about why business financing matters, give you ideas about where you are in the life cycle of your business and where you're likely to get the most looks when it comes to a lender or someone else providing you capital to build or grow your business. What a bank looks like and how to be bank ready. That's going to be the 6 C's of credit and bank readiness. Understanding loan products available in the marketplace, the SBA and SSBCI are credit enhancements that are typically suited to assist young and growing businesses and in many cases startups as well. Alternative funding, angel investors, venture capital. I'll just give you a very, very high level overview of typically what we see when we see venture capital or angel investors or private equity or something like that in a deal, and how that typically impacts a deal. And then just very, very high level overview on some scams and what to look for when considering a grant. And then we'll summarize there. Okay. So, okay. Why business financing matters in the USVI. The first three boxes here are this is data that we got from the U.S. Chamber of Commerce. This is national data. It's just important to know that small businesses are often referred to as the lifeblood of the U.S. economy. That's pretty telling when you look at some of these statistics. Nearly half of all private sector jobs and private sector earnings are generated by small businesses. 99.9% of U.S. businesses qualify as small businesses. That's a measure that's usually established by the SBA's thresholds. The SBA's thresholds are typically the lowest I've seen them is 500 employees. If you're over 500 employees, you're no longer considered a small business. And if your gross receipts, it's dependent upon industry. But if your gross receipts are over 7.5 million, there's a table on the SBA's website that you can look at to identify whether or not you're a small business. So that's just, if you're applying for SBA financing, that becomes an important consideration. If not, just kind of good information to have when you're trying to access capital. And access to capital, I hear it all the time, and I see it whenever we do presentations like this. It's a pain point, and it's a point of frustration for Virgin Islands entrepreneurs. There's often a perception that the banks don't lend money. What we're going to do is show you why, in certain situations, someone applies to us with an incomplete application or something that's just impossible to consider because they haven't armed themselves, prepared themselves appropriately, or documented their request adequately to be met with favorable consideration when they come to a bank for financing. So we're going to go over that and try and give you guys some best practices, real world advice about how to get yourself ready. Slide 2. If this is going to tell you what's realistic for you to really go after and get, depending on where you are in the life cycle of your business. If you're just at the idea phase, you haven't made any money, you just think you've got what could become a business ready, you're less likely to get looked at by a bank unless you're willing to put something up. That's where equity from owned assets comes in. But really, this is the bootstrap phase. This is where you should be prepared to put your money where your mouth is and get your idea off the ground, even if it's in a smaller fashion than and you think it can scale to a much larger business if you have the adequate capital. Maybe being in a position to prove concept with a low investment, that's kind of what you're looking at. Maybe a micro loan, also hard to get at this point. Personal savings, gifts from family, leveraging an owned asset. If you own a piece of land or something, or if you have something that's of value, you can potentially find a lender who will say, okay, I'll give you 50% loan to value on that, and you can pursue this idea. When you're in the startup and in the growth phase, this is you may be able to secure an SBA loan or a traditional loan from a bank in the startup phase. Be prepared for them to look at outside collateral. If you do, you might be able to attract an angel investor. That's someone who will provide more than just capital, but a little bit of guidance along the way. Typically, you might also be able to come to a local bank. And if your business plan is strong and there are other mitigating factors, if you have invested decent equity into the project, there is outside collateral, there's outside cash flow. That de-risks a bank. If there's a lot more to fall back on and consider. So you might be able to qualify in that first couple of years. Certainly in the growth phase, when you've got your feet underneath you, you know exactly what your business is doing and can do if you have an equity injection or a debt financing injection that'll carry you to the next level. There's a couple of loan programs that are of particular interest in that growth phase category. The SBA 7A and 7A Express loans. Those are loans. 7A Express loans are up to 250, and they can be 5-year term loans, 7-year term loans, lines of credit. Your lender has a great degree of autonomy in how they structure those loans. The challenge with a 7A or 7A Express loan is if the loan is greater than $50,000 in size, and you happen to have outside collateral like a piece of real estate or something like that, the SBA is going to look to put a lien on that outside collateral. The SSBCI guarantee or cash collateral support programs, both offered by the USVI Economic Development Authority, are programs that will afford you as a borrower a credit enhancement in the form of a cash deposit that gets placed in the bank to support your credit request. Now, how that works is typically you would make an application to us. If you pass our credit committee, we would go to the SSBCI and say, hey, we're willing to make a loan to this young business if you're willing to provide a cash guarantee of 50% of the loan amount. And the EDA will look at it and say, you know what, we believe in this project too. We're going to go ahead and put 50% of this loan that you're going to make to this borrower, this young business. We're going to put that in the bank as collateral for the loan. That makes it a lot easier for a bank to consider a young business for credit. These credit enhancements are not free, but in the case of the SSBCI, you don't have to necessarily pledge a mortgage on owned real estate, whereas the SBA does if you eclipse that $50,000 loan size. Another really valuable tool, aside from a traditional bank term loan line of credit or a loan that's supported by a credit enhancement like a 7A guarantee or an SSBCI guarantee, are vendor terms. If you're purchasing equipment, that's typically where we see vendor terms the most. So if you see, a piece of equipment, many of them will offer in-house financing. Is it the best interest rate you could probably qualify for? No, but it's going to be the most flexible financing that's available, because at the end of the day, the vendor can just take the piece of equipment back and they'll know exactly what to do with it, and they'll be able to repurpose it if you ever get into a problem and don't pay. At the expansion phase, your business is seasoned, it's pretty mature. There aren't the same level of questions that you would typically have in the startup phase. You will have a time horizon or a history where you've proved out that you can make money, grow, and probably weather some adverse economic events. So that's where it becomes a lot easier to qualify for credit. And you can look at, your basic traditional things like a conventional term loan, line of credit. You can still always get SBA or SSBCI supported loans, but you might not need them at that point in time. Moving on to the 6 C's of credit. This is a number that grew from 4 when I first got out of college to 5 and now 6. All of these are evaluation criteria that a bank is going to look at when considering an applicant for credit. Character. They're going to be looking at whatever information is available publicly to determine your track record and reputation for paying bills and running a good, clean business. It goes beyond just credit, though. Reputation is a big component. If there's a daily news article about you being suspected of committing fraud and you come into the bank the next day seeking debt, that's going to be something that a bank considers and a loan committee considers. That's that's a major red flag. It's something that has to be investigated, and it definitely puts you behind the eight ball when it comes to making a lender comfortable to make a bet on you and make a loan available to you. Capacity. Based on the financial information provided, can the borrower repay the loan that they're seeking? If this is the performance and the ability to make the payments is based on projections, it's very, very important that you document and articulate your assumptions that go into whatever projection information you give a bank very well. You have to be in a position to defend your numbers and why you think the numbers will grow the way you've indicated that they will, provided you get the loan that you're seeking. Capital, how much have you invested in this? Skin in the game is an important consideration. For business credit at merchants, we typically like to see at least a 15% equity injection into a project. So let's say you've got a young business, it requires $100,000 worth of equipment in order for you to take the business to the next level. We would approve a loan for 85% of that $100,000 request if we believe in every other component of the application. That means you would have to be in a position to put up $15,000 of your own money in support of growing the business to the next level. So that's an important component of this. Even with credit enhancement, like SBA loans or SSBCI loans, you're going to have some cash equity invested in the business above and beyond, the time, sweat, et cetera, that you've invested into growing the business to the point that it's at. So that's important. Make sure you're in a position that you can contribute something to an equipment purchase or other credit requests. And typically that amount is around 15% at a minimum. Collateral. What's going to secure the loan? What is securing the loan here in the event that things go sideways? Do we have a lien on real estate? Is it a UCC security interest on equipment, inventory, accounts receivable? What are you offering the bank that says, hey, if this doesn't go the way that we think it's going to go, this is what you can use to basically pay off the loan. You can take this back and pay off the loan. Conditions. Is this the right time? Is this the right economic climate or time for this type of business or loan request? This is my favorite example of something like this. Would you make a loan to someone in today's world who specializes in selling and servicing fax machines? Probably not. That's not an economic climate condition. The industry trends have gone completely away from that archaic form of technology. So that's not a business that, they could put all the projections in the world and give you a great marketing plan. If it doesn't make sense, it just doesn't make sense. Let's say someone walked into the bank's doors the day after social distancing was announced after COVID and said, this is the perfect time for me to start a bar and restaurant. We tell them it's not. And that's something that you have to be mindful of. Evaluate your business idea in the current economic climate and do your best to try and see what the economic environment is going to look like in the next 3 to 5 years. Would your business still be viable in 3 to 5 years? What would have to happen for it to not be viable, and evaluate whether that's possible or probable. Credit, your personal credit history, late payments, charge-offs, collections, settled less than full balance, trade accounts are definite red flags when it comes to evaluating your personal credit. It becomes something that a loan committee looks at and considers very well. When they're evaluating you as a personal guarantor, your ability to step up if the business projections are not necessarily going the way that you expected them to. If the business doesn't make the level of money that you thought you were going to make, are you personally going to be in a position to step up and support that transaction? And if you have a spotty credit history, it gives a bank less confidence that you're willing or able to step up in that situation. Getting bank ready. What can you do today to improve your borrower profile? First things first. If you have, I know it's the third box, but your business structure should probably be the first thing you do, because in many cases, you can't adequately separate your finances and establish a business checking account unless you have a formalized and organized business. So it's important to make sure that you shield yourself from liability by establishing a corporate entity like an LLC or a corporation. You can do all of that pretty easily now on corporations and trademarks .vi.gov. You don't necessarily have to hire an attorney for that. But if this is your first go around and you're not necessarily sure about what makes sense for you, talk to an accountant and talk to an attorney. They will guide you as to the strengths and weaknesses, or pros and cons, rather, of going limited liability company, establishing a partnership, S corporation, a sole proprietorship. There are a number of corporate structures available to you. And it really depends on your personal circumstances and your affinity for paperwork as to which one you should organize under. Once you've organized, make sure you try and separate your finances. Don't commingle money. Don't run a business out of your personal account. Banks generally don't like that. And on top of that, for transparency, it becomes much easier to know how much money you're taking in and how much money you're spending if there's a dedicated bank account. Oftentimes, entrepreneurs will come to us and they'll treat something as a business expense. It's really a personal expense, and vice versa. And if you treat all of your personal expenses as business expenses, that reduces or shrinks your net income on the business. When a bank goes to evaluate your net income and its ability to pay a loan back, they're going to say the business doesn't have enough cash flow to make the loan payment. So that's important. Try to keep your business financials separate, not only for the lender but for you. It's a good way to identify whether the business you are starting up is a real business or is it just kind of a hobby. It's important to know what you make out of your business before trying to take on debt, raise equity, because you may be in a position where you're funding something that's not going to make you money. And it's going to cost you a lot of time and energy, and it's not going to pan out quite the way you expect it to. Number 4, very important, keep clean tax records. File on time, file extensions on time. I think yesterday was the filing deadline. Hopefully everyone got there. And if didn't file your actual returns, at least an extension. It's important to do that. It demonstrates responsibility to a lender. And it also keeps you from penalties and interest, which in some instances can be quite costly. Demonstrate cash flow. Be in a position where your cash flow is more than adequate to meet just the minimum loan payments. Typically, a bank will evaluate a debt service coverage ratio. That's cash flow divided by the annualized debt payments of 1.25x minimum. That means you have to have at least 25% buffer cushion over your annualized debt obligations in cash flow to give a bank some comfort that you can weather a storm. Maybe revenues are slower than you expect in 1 month, and your projections are basically not going to be attained. That's why sort of coverage ratio is important. A bank is evaluating whether or not you can manage the debt you're looking to take on if your expectations don't pan out quite the way you do, quite the way you expect them to. Prepare your narrative. This is very, very important. You got to know your numbers. You have to know your numbers inside and out. You have to be able to explain to a third party, which is a bank and its credit committee, that this is what your business does. These are the things that impact your business. If you had whatever you're requesting in capital available to you, you could grow the business in this form or fashion, and it should generate this much in additional cash flow. Equally important, look back at your last 3 years of operating history, your income statements, your balance sheets. Look for any material deviations from year to year. If you had revenues go from $500,000 to $210,000 to $380,000 over a 3-year period, you should be able to explain what happened in those 3 years, what was distinctly different in the $500,000 a year versus the $210,000 a year. is an average of those 3 years of good expectation going forward was $500,000 an outlier, never going to realistically be able to attain that again. Be in a position to explain what happened. Maybe you were closed for a month and that was what resulted in the lower than normal revenues. Be prepared also to be able to justify things like that on the expense side of the equation, as well as on the balance sheet. Lenders will want to know, and in many cases, we'll have a good idea based on whatever macroeconomic event is happening and how it could impact your type of business. But they want to hear it from you. They want to know that you know that hey, I'm in a tourism related business. I started at a time of year where it was off season, so that first year doesn't really capture a full year of performance. The second and third years, though, that's where you see that I'm running full throttle. I have the benefit of a full 12 years, and I've been able to do far better than that stub year where my results are dominated by a 3-month stretch of off season. Very, very important to know your numbers. Financial documents and legal docs that a bank is going to collect. Now, some of the legal and supporting documents you're not necessarily going to have during the application phase, but some of them you will. If you're a startup or a relatively young business, a bio of the key management is helpful because it gives some credence to what kind of expertise you have in this business. List of business owners and ownership percentage. That's important to know up front. Reason being, bank's going to ask anyone who has greater than 25% equity to pledge a personal guarantee in support of a credit request. So knowing right away who are the owners, who do I need to be collecting financial information from, super helpful. Moving on to the financial documents, 3 years business tax returns, 3 years personal tax returns, your current year profit and loss. So let's use today as an example. If you filed your 2025 tax returns, we're going to want to see 25, 24, 23, but we're also going to want to see the first 4 months of 2026. How are you trending? Is everything continuing to look the same? Are things worse? Are things better? That gives us a good sense of how you do during interim periods. It'll tell us what you're doing in this peak season month or peak season quarter, and it'll give a bank some insight that wouldn't just be available on if looking at the 2025 tax returns. Plus, it's fresh. Asking a bank to make a credit decision on 4, 6, 7-month-old data, not the fairest thing in the world to do, especially if you're a younger business. If you're a much more seasoned business, you've been around for 20, 30 years, the interims are important, but they're less important than if you're a younger business. Beyond the bank, alternative funding. What are some alternative funding sources? Let's start with the column on the left there, angel investors. Again, this is someone who's you're not just looking to give up some equity to an angel investor. This is someone who you're hoping will be an active mentor, maybe have a seat on your board of directors, and really you leverage their experience to take your business to the next level. Angel investors are not free; they have equity requirements, and in some cases, if they also provide some financing in addition to whatever equity injection they make into the business. They'll charge a premium or they'll structure their loan to be paid out first. There's many things that an angel investor can do. Don't be afraid to negotiate with an angel investor. I think any angel investor would like that a borrower at least asks a couple of questions about deal structure rather than just kind of accepting, you're going to give me a check. Awesome. I don't have any questions. Make sure you ask questions if you do take on an equity investor early in your business life cycle. Venture capital. This is when you've got something, and you know that you've got something. It may be tough for a traditional financial institution to get you where you need to be for whatever reason or circumstance. That's where a venture capital group will come into play. They're going to want to get their equity paid out back to them. They're not typically in the business of keeping their stake in a company for the life of that company. They're going to charge you a higher than market rate of interest on money, and they'll tell you, okay, every quarter we need to, after a debt service coverage ratio of 1.25 times, before you as the owner take any distributions and profits, we need to get paid this. There'll be some kind of agreement where they get paid out earlier rather than later. CDFIs, community development financial institutions. We've got two here. Inclusive is out of Puerto Rico, and the RT Park actually has launched the Community Impact Fund. That's a CDFI that will give you a loan with traditionally less stringent underwriting standards than a bank would offer or require. So they're a little bit more flexible. They're designed to help low, moderate income neighborhoods. That's the communities that they're primarily focused on lifting up. So they're a good option. They're a very, very good option if traditional bank financing just doesn't become an option for whatever reason. Crowdfunding, all you usually have to do in these scenarios is give an early investor a special deal. I see a lot of projects that don't get funded. We always see the unicorns, right? The ones that they were looking for 300,000 and they raised $1 million. But it's tough. It's tough sledding. These are probably very niche products or tech solutions. Is it practical for you to look for crowdfunding to support you if you're doing something that's a little bit more traditional in the form of a business? Like if you want to open a retail location or a bar restaurant or manufacture some product, unless it's a really unique product in its space, crowdfunding is probably not going to get you where you need to be. Section 6, we were asked to spend a few minutes talking about grants and scam awareness. So there's no such thing as a free lunch. That's pretty common saying. I forget who said it, so please don't ask me. But effectively, what that means is just be very, very cautious. If you get an unsolicited message, someone says, "Hey, we've got this money available for you. All you have to do is give me this," and then you get that. That's a pretty good telltale indicator that there's a scam. Something is not right. Be on guard, have your spidey senses up, make sure that you're not falling for something that would cause you to have a problem. We just yesterday had someone come and tell us, I've got $30 million walking in the door. All I need to do is send them $7,500 first. We had a talk. It was a long conversation. We said, this is why this doesn't make sense. What sense does it make that they're going to give you this, but they need you to send them $7,500 up front? It just does not make sense. So be cautious, have your guard up. It happens to a lot more people than you'd think. So be very, very careful. Grants will not proactively reach out to you. Grants are competitive. They will be announced. You will be given a list of information that you need to provide in order to be considered for a grant. And then there's a process where you are qualified to see if you are more deserving in the grantor's eyes of that award. So no one's going to call you up and say, "Hey, I have a grant for you." That's no obligation, no catch, no nothing. You don't have to sign. It just does not track. Okay. Resources that you can go to for additional help. I've put some up here that I think are important for you to take a look at. The SBDC and SCORE are fantastic for helping you if you're in that pre-revenue kind of incubator phase, you're thinking about starting something up, or even if you've just started something up and you're not 100% sure where to go to get to the next level or to get to the point where you're bank ready. They're both excellent resources that can provide you the guidance you need to move on to the next level. The EDA and SBA websites are great for just kind of getting a high level understanding of the programs that are offered by SBA lenders and lenders participating in the state small business credit initiative. Ultimately, neither of them make direct loans. Using those credit enhancements I spoke of specifically, you would have to reach out to a lender. So call a lender in your market. If it's merchants, great. We'll do everything we can to help you and give you advice as appropriate. If it's another lender, if you've got a relationship at Banco First Bank, wherever, everyone should be equipped and able to answer your questions. Grants.gov, there's federal grant opportunities on the database there. I haven't heard of a ton of people, very candidly, having success collecting a significant amount of grant dollars. But if you're able to spend the time and energy writing a grant, there's a possibility you might be able to get some money that will help your equity stack, so that you're not putting all of your personal cash up. It's also good if you get something like that. It's not, I don't want to say it's a third-party endorsement, but it rings true that you're responsible enough to have produced application materials that a third party looked at and made a decision to fund you based off of that. Helps you when you get to a bank and look for debt. Annualcreditreport.com. If you're not sure what your credit score is today and you don't necessarily want to do a hard pull and you don't want to use one of those third-party services that may put your name on a list and you might get a whole bunch of unsolicited emails after you check with them, annualcreditreport.com is the federally given resource that will provide you with all of the content, all of your active trades and your trade history as well for closed accounts, all the content on your credit report. So you will be able to see what the bureaus see, and that's a great resource to use, particularly to check and see, is everything right? Are they reflecting late payments or charge-offs or anything like that aren't associated with me? It'll help you identify if perhaps your identity's been compromised early. And you can get one of those free reports once a year, every year. Highly recommend doing that. Some things that I think that everyone can do this week very easily to kind of get themselves together. You can make sure you're organized correctly, talk to a professional, see if you're at a point where you need to organize formally, figure out which corporate entity type is best for you and your unique needs. Get yourself to the point where your finances are segregated. Put the financials together, take a look at them, and high level make sure that you understand them and can explain them to a third party. This is why my revenue was the way it was this year. Next year it went up or down because of this reason. My expenses went up because I had to hire more people, or utilities were higher, or I had to do this. Be in a position to explain your financials very clearly to someone so they understand what normal cash flow looks like, and if there's any variables and variances in your look back period, what would have caused those variances and why they're outliers and not the norm. And then write up a few sentences about what it is you think you need in terms of financing, focusing on what you need, why you need it, and what the impact of implementing whatever you intend to do with that money will have on your business. Be in a position to answer those few questions. It'll take you a long way. We have a lot of times where people will come in and say, I need $150,000. Okay, can you tell us why you need $150,000? Well, someone told me that that's a good line of credit to have. No, it's not, that's not an adequate reason to support the request. So you need to understand your business and be able to explain why the money you're requesting will be sufficient to take you to the level you need to get to. A couple of financial ratios for you to be mindful of when you're kind of considering a request. If your debt service coverage ratio, which is your net operating income, your sales less cost of sales less operating expenses, divided by your total annual debt payments. If that number is 1.0, that means that you are making just enough to cover all of your existing obligations. That means there's no margin for error. If you close for a week, you're going to be in a problem. If you have 1.25 time debt service coverage ratio, that's usually the minimum that a bank will require for business debt, 1.2 to 1.25. If you're looking at 1.75 times and over, that's considered a strong request. That will be the best. Those are going to be scenarios that are most likely to get a good strong look from a loan officer and or a credit committee. Your current ratio is going to be something that measures your ability to meet your short-term obligations. How can you pay your bills with your cash and other liquid resources? If you cannot, it raises questions about the business's viability. If it's just a timing thing, like during a slow season or a slower time of year, you're not able to, but you're more than able to during a busy time of year, and you save to account for the fact that you typically don't have revenue at the same level as lower times of year. It's important to be able to demonstrate that you can meet your short-term obligations with your cash and your short-term convertibles. Like if you have 30-day terms available to a client, that's usually considered a liquid asset and part of your current asset base when evaluating your current ratio. Debt to equity or leverage ratio. Easy way to capture how much skin in the game you have compared to your debt level. The lower the number, the better, the less risky for a bank. Gross margin. Are you operating your business profitably? We compare to similar businesses to identify if you're average, ahead, or behind in this category. It will tell you pretty easily and pretty quickly if you're pricing your products and services correctly as well. So, for example, a food and beverage business, the cost of sales typically is around 38-39%. If we see someone show up to us and their projections or even their historic numbers say my cost of sales is 8%, automatically we're questioning that. That's it seems like a red flag to us. We're saying how could you possibly be that much more efficient on your buying than all the other bars and restaurants that we've happened to look at in the past. So just know that number, know what it typically is for your industry, and see if you can benchmark yourself against industry businesses to know if you're on par, ahead of the game, behind the curve a little bit, and you need to get a little bit more efficient. That is the extent of my presentation. Once again, my name is Ro Kiani. I'm the Vice President and Chief Lending Officer at Merchants Commercial Bank. We have the ability to initiate a credit request by sending you a link to a digital checklist, and we can collect all the financials that are necessary. If you're at the point where you're ready to apply for some financing, you can send inquiries to lending@merchantscommercial.bank. That's lending@merchantscommercial.bank. And should you just want to have a high-level discussion to find out if you are bank ready, we're happy to do that as well. You can send inquiries like that to lending@merchantscommercial.bank. And if we don't think you're quite ready, we can make a referral then to someone at the SBDC or SCORE to try and get you where you need to be to reapproach a bank and get more favorable consideration.
All right. Thank you so much, VP Kehani, for that presentation. So we have arrived to our question and answer segment. If you wish to ask your question directly, you can raise your hand and then you can unmute and ask. And if you want to put your question in the chat, we can also facilitate an answer that way. Okay, so I don't see any hands raised at this moment. So I guess you can go back, VP Kehani, a slide. Let me just make sure everyone knows how to find us. Ready?
I moved my mouse off of the screen.
That's okay.
All right,
So
here we
you
go.
see persons in the chat saying thank you for this presentation. It was very informational, educational. So, with this slide being up, the VI SBDC has so much more in store for our USVI small business community. You can visit our website at www.visbdc.org. Follow us on Facebook, Instagram, Twitter. Subscribe to the VI SBDC YouTube channel for uploads of our webinars. We encourage you to download the complimentary app in the App Store. So, it's the VI SBDC app. And I do want to spotlight a few of the trainings that we have coming up. So what I'm going to do is I'm going to share my screen, take you to our website, and show you how to find this in a different format. So here's the VISBDC website. And so we make sure that our trainings remain accessible to our audience. So when you select the training tab, go down to events, you're going to end up on this page. This is just a few of the subject areas that we cover. And we have our in-person government contracting and matchmaking summit coming up. It's a territory-wide event. So it happens on St. Croix first, and then on St. Thomas, it's at our university's campus. So on St. Croix would be at the Great Hall, and St. Thomas is going to be at the 13D Innovation Center. So in regards to our trainings, I want you to understand that when you want to see this at your leisure, when you go on this page, pay attention to the event type. And if you select on demand and you search, everything that we had in the past relevant to that week would come up that you can go ahead and you can just sign up and watch at your leisure. With regards with what's to come, make sure you search live and then you'll see what's coming up. So tomorrow we have SBA Senior Area Manager Wayne Huddleston. He's presenting on SBA Federal Contracting Certifications. That webinar will start at 10 a.m. He returns on April 21st. We're going to be covering business resiliency as it pertains to disaster preparedness. And to close up Financial Literacy Month, we have VI SBDC advisor Daryl Edwards. He's going to be presenting on Blueprint for Success, a practical guide to writing a business plan. Those are all webinars. And then we have our in-person government contracting matchmaking summit happening on both May 5th and 6th. And we want persons who are connected to our Agriculture Business Center on May 6th. We have Helping Farmers and Fishers Thrive, the Community Impact Fund. And so we want you to go ahead, register for as many of these as you can. You will receive an email with the Zoom link to attend. And so therefore, I'm going to go back over here to see if we have any questions. And we do. So question VP Kihani, how do you evaluate whether to deploy capital as a principal investor versus structuring a deal for clients? And what factors usually tip the balance?
Sure. So let's say this is a question that comes up a lot for solar financing, solar companies. We've had a couple of solar companies who've said, what are the protocols that you determine? How do you determine whether or not someone's a good risk? And you make some evaluation criteria and metrics that are important for you to consider. So if let's say you want to give terms to some of your clients, which is pretty common, 30, 60, or 90 days, make sure your agreement speaks to what happens in the event of non-payment. Make sure that you have penalties and interest if someone doesn't pay you on a timely basis, and make it clear that you can pursue a collection action against them if they don't pay you within time certain. But in terms of making the decision ahead of time before making credit available to a customer of yours, just try to ask some basic questions. So for the solar guys, what they'll do before they consider making a loan to someone to buy a solar array is they'll say, show me the last 18 months of your WAPA bills that you've paid. Have you ever been late on a WAPA bill? Do you own your home? Things like that will flush out whether or not this is going to be someone who's a responsible person for you to extend credit to. I'm hoping I understood that question correctly. Did I understand correctly that you were trying to give terms to clients of yours and you wanted to know how best to structure that?
It wasn't my question directly, so thank you for answering. I will give them time to put their response in the chat. But
Yeah.
thank you
If
for
I missed it,
answering
let me know
anyway.
and I'll see if I can provide a better answer.
No problem. And I do believe we have someone who has unmute and want to ask a question directly. Louis? So that did answer our question. So I guess Louis doesn't have a question, so I'll go back to the second one mentioned in the chat. Is line of credit for the business recommended?
Sure. So what a line of credit is it's designed specifically to handle your short-term working capital obligations. Think of a line of credit. Let's say you run a tourism-based business. You rent jet skis on the beach. You're very, very busy when cruise ships are in port. You're not so busy during August, September, October. What a line of credit is ideally designed to do is give you a little bit of a cushion so that when you get to August, September, October, you can still pay your employees, you can still pay your day-to-day operating expenses, your rent, whatever, repairs and maintenance on your equipment without when revenue is at its lowest. You still have the opportunity to cover all those obligations. And then when revenue starts to kick up again, you should be paying down that line of credit back to zero. A line of credit is like a credit card. Um, a term loan is what you're going to want to use to acquire a fixed asset or make a significant investment in your business. Um, you have one jet ski and you need to upgrade to three jet skis. That's what you use a term loan for as opposed to a line of credit. Line of credits are typically interest only on a monthly basis. And then when you borrow, when that term ends, there's a term called principal payable on demand. So back to our jet ski example. Uh, it's January 1st. The jet ski is granted a line of credit of $100,000. Um, he doesn't use it until August, September, or November. And during those months, that owner borrows $10,000 a month, draws $10,000 a month to cover all of his short-term obligations under that line of credit. And let's say, November doesn't go quite the way he expected it to, and December he got a little bit careless and didn't pay down the line of credit. He's going to incur interest expense from the day that he borrowed that money for the first time, the day that he first drew that first $10,000. And he's going to be paying interest on that sum of money while it's outstanding. But what's going to happen is a line of credit is typically 12 months, right? So January 1st is going to come around. The lender is going to say, hey, you have $30,000 outstanding on this line of credit that you didn't pay back. My loan agreement says that you should pay this back immediately, or we can term it out over the next 3 to 6 months. So you're going to have to pay this back. If you're going to have to pay this back over a finite time period that the lender is going to decide at that point. A term loan, it can be a 3-year term loan, a 5-year term loan, a 7-year term loan, and every month you're paying principal and interest. And then at the end of that term, you should be done and have no outstanding debt obligation on whatever asset you buy. So a line of credit is really for short-term working capital, not intended to fund long-term fixed asset expenses. Term loans are what you should be looking for when you're thinking about expanding or buying equipment or something like that. So to answer the question about should a business get a line of credit, you may not necessarily need one. If your business is such where your cash flow is pretty consistent and steady throughout, and there's no seasonal disruptions or anything like that, you don't necessarily need one. But if you are in a position where there's pretty significant swings, a line of credit helps you smooth out your cash flow over that 12 months. So you're not stressed during those off-season months about how am I going to make these payments? There's no business. How am I going to make the payments? It's that's when a line of credit becomes a valuable tool.
All righty. Thank you for that. Here's one more. What trends are currently changing how merchant banks source and structure deals?
So we've spent a lot of time in the past 2 to 3 years focusing on small businesses more so. We just looked around and said, this is kind of an underserved market. Not very many people. Everyone's complaining they're not getting they're not getting looks. They're not getting opportunities from banks. So we just got notified that we won SBA Gold Lender of the Year for the second year in a row. We're very, very active users of the State Small Business Credit Initiative for credit enhancements. So I would say we're doing a lot more commercial and industrial financing than we were maybe in our first 2 or 3 years of operation. We hope to continue that trend. We hope that we can continue to be a good resource and a good corporate citizen to help small businesses kind of take themselves to the next level. And so deal structure wise, we are seeing a lot more credit enhancement requests come to our loan committee. On top of that, there's not a whole lot more that's unique about our products and services. We're firmly in a tourism centric market. So we do understand, structuring lines of credit and things like that to businesses that have some tourism vulnerability and some seasonality is what we talk about, or what we say for businesses that have distinctly different revenue cycles throughout the year. And then we're now gearing up to position ourselves to try and help some of these medium and small size contractors that are going to be trying to qualify for subcontracts for some of these major redevelopment activities that I don't know. They keep saying that we're going to start construction. So there's a lot of construction volume that's supposed to be unleashing pretty soon. We recognize that there's some smaller contractors that might not necessarily meet the requirements to qualify as a prime contractor. And just knowing that, when you submit an application for payment, if you've done a piece of work as a contractor, sometimes it takes you 3 to 6 months to get paid. They're going to need lines of credit. So here at Merchants, we're focusing our energy and attention to be prepared for not just your retailers, your commercial real estate properties and those types of businesses, but also contractors and logistics people, all the businesses that are going to be impacted favorably, hopefully, by all of this redevelopment money.
Alrighty, thank you for that. Here we go. We have another one. I met someone, he worked in credit, a commercial credit analyst. He said he could help me structure my loan application and help strengthen the C's. Should I hire him?
Uh, that tough to say. I do think before you hire someone, why don't you try making availing yourself to the resources that are free and available here. The SBDC actively is looking for people that they can support and provide some basic information to. SCORE as well. SCORE is actually staffed by former entrepreneurs who are just retirees at this point. So a lot of them, even if they don't necessarily understand your specific business, they'll understand what it takes to run a business, and they should be in a position to help you shape your credit request to a point where it might be bank ready. You might not need to pay anything to do that. I would start with the free resources.
All righty, thank you for that. Okay, everyone, thanks you for answering their questions. So at this time, with no hands raised and no more questions in the chat, I think it's safe to say it's always a pleasure to collaborate with Merchants Commercial Bank on initiatives like this. And so we thank you for your time, VP Kehani. So once again, to everyone in the audience and on behalf of the entire VISBDC network, compliments of State Director Karen Jones, thank you for being here and we wish you a productive rest of day. Take care, everyone.